Why don't we start with the elephant in the room? What does a new president in the world's largest market for M&A mean for deal-making on either side of the Atlantic? Alison, if I can start with you and then go to Christina.
So, look, it's definitely awakened the animal spirits, I think it's fair to say. We were seeing, I think, and expecting an uptick in M&A activity regardless, because we're still sort of coming along the bottom from, the peak of 21. But I think the level of discussion and the level of pipeline building is clearly increased. So the expectation is that there will be less regulation, it will be easier to get deals done. Hopefully, financing remains relatively cheap versus the past couple of years. So I think people are looking forward to a very active year next year. Now, that doesn't, in my mind, mean we'll hit the crazy point of 21, where there was over $6 trillion of deals done. This year, just by comparison, we're at about 3.3 so far. But I think it does mean that particularly end of first quarter, second quarter, we'll start to see a lot of big transactions. And you've already seen that if you think about deals that we saw announced in the US, even in the last couple of days, by the way.
And just before I come to you, Christina, I want to remind the audience that if you'd like to send in questions, we have a QR code which is going to show up on the screen. If you could just scan it, we may not get to all of them, but I will definitely try to. Christina.
Great. You notice how we all have a symphony in green? We color coordinated our outfits. Actually, we didn't. So I think since the election, there's been an increased amount of inquiry, both from sponsors as well as corporates that were either on the sidelines or nervous about what was going to happen. And so it was quite clear-cut what happened. And now people are sort of dusting off their blue books and saying, let's get back at looking at things strategically. I think our own House view is that his policies, at least what he's said he would run on and implement, would suggest growth is going to pick up in the U.S. So I think there's probably a sentiment that the M&A activity in the U.S. might be slightly more robust, a little bit more reservation about Europe, just in terms of some of the concerns around his posture on tariffs, et cetera. And I completely concur with Alison's perspective around regulation. It's got to get, obviously, better than we've had in the U.S. under the prior regime. And I do believe it'll be kind of industry-specific, because there's certain industries that might have slightly different dynamics around M&A and consolidation. But in general, we're quite bullish, and we also concur that towards the middle to the back half, just based on how long it takes deals to kind of germinate, that it'll really pick up summertime and into year-end.
And just coming to that point around reservations around Europe, we've had some data this year that shows the Euro Stoxx 500 has had its worst performance in decades compared to the S&P 500. And this whole idea of European companies lagging behind their US peers. Now, a lot of European companies, of course, are owned largely by family shareholders relative to other markets. Simona, my question to you is, are you seeing more of these kind of company-owned, family-owned companies thinking about going private and then maybe reaching out to private equity firms and talking more about public-to-private kind of deals?
No, definitely, Ruth. Everything you're mentioning in terms of the differential in valuation between European and US company actually does very well for us in terms of public-to-private activity and PE willingness to invest in Europe and take company private. We have seen already a wave of P2P in a lot of European markets, especially in the UK. The PE use a very standard playbook of finding value, of breaking companies, doing a buy and build of some sectors. And it has worked well in the last 5 years, and we expect this trend to accelerate. In Europe especially, where the public market have been very fragile, there is definitely a rationale for a lot of companies to actually leave the public market, leave the scrutiny of quarter-to-quarter result, meeting to investor, being in private hands, and sometimes teaming up with the same families that took the company public, so that outside the public scrutiny, they can really refocus on the business and their grow and thrive. And then sometimes after 3-4 years, this company are ready again for the public market.
One of the other things that we are seeing is deal completion times. They're taking a lot longer to get done. And there's a lot more talk around regulatory approvals being harder, companies needing to make more concessions. Christina, what are you seeing in terms of CEOs taking that into consideration when they are embarking on transformative M&A? And do you think that that's going to change in 2025 because the incoming US government is making a lot of anti-regulation, pro-business noises? The Labour government, for instance, in the UK is saying that they want to make it easier for companies to do business. Do you see that changing?
I think I'll make a macro comment that I see when we're selling a business at Goldman, and we have strategics and sponsors, and we have a strategic that may have an asset that is competes with either a division or competes directly. We're quite cautious about how we think about that particular buyer. I don't think that's going to change dramatically because I think it's always a dynamic. Is there any HSR or regulatory approval risk versus a plain straight up sponsor transaction? I'd say that there's probably a little bit more a nervousness around even when a sponsor has a competing strategic asset, what that could mean for slowing down an M&A process. As it relates to the UK, I think I'll defer to my colleague Alison because I spend most of my time in the US, but I do think it's definitely in the boardroom. Also, when you're on the buy side, we spend a lot of time. I'm working on a transaction right now where, again, there's a asset that we're looking to acquire, and there's some overlap, and we're quite concerned about completion risk.
Look, I think, Ruth, it's fair to say that over the past 4 or 5 years, regulations have gone up. Some of that happened during COVID. You'll recall they haven't come down. The mindset is the US has definitely been much more difficult under Biden, and that will change and get better. So what does that really mean? It means that actually a lot of deals that maybe 10 years ago you'd tried and thought you'd found a way through with remedies or whatever you needed. Now, I think people aren't even trying in some cases. So a lot of deals aren't even trying. You've seen some big deals, particularly in the US, that have actually been sitting for over 2 years waiting for approval. And who knows if they're going to get approved. The expectation, I think, is that will get a little bit easier. I think on a geographical level, if you think about, deals we saw 10 years ago, China into the US or China into Europe, I still think that's more difficult. I think that will always get a lot more scrutiny, and certain sectors will always get a lot more scrutiny, particularly tech, semis, that sort of area. But I do think that people believe the environment will begin to be a little bit easier and maybe even a little more aligned between the UK, Europe and the US at some point.
Just staying with the idea of risk, earlier today, Alison Rose at Charterhouse was talking about how there's this valuation arbitrage that she sees as a real risk because companies were sold at valuations that were not their true valuations, and now they're trying to grow into those valuations. So you've got this huge backlog, and private equity, I would say, would be very much a part of it. I guess my question is, how much is this backlog going to impact private equity deal-making next year, and what does it mean for their ability to go out and raise more cash?
I think the backlog we need to unblock next year because of the fundraising dynamics. I think the PE realized that they can't just take chances. The timing they raise fund is very important, and the environment for fundraising is improving. But when we look at fundamentals, companies have started to grow in their valuation. We're seeing interest rates moving in the right direction, but we're also seeing improved performance of the businesses. And it's true in Europe, we're not seeing a lot of growth, but a lot of the PE portfolio company have always looked at the US as one of the driver, one of the investment theses. So in the past, what has prevented deal was this bid-ask on valuation, and people thought sponsor needs to be realistic and reduce the ask, which is true to a certain point, but the economics do not work like that. If they're not in carry, if they don't make the returns, they can't really do, but we're close to that. So I think next year, because of, I think the valuations that bidders are going to pay is going to go up a bit, and they will meet not halfway, they will meet, I think, at the right level. And when you think at the numbers, there are a lot of companies. The installed base is around 3 trillion globally of companies that needs to be sold, and most of them are older, 5 years and longer. So the cycle needs to start again. That's the way the PE business model works. So I'm very optimistic on 2025.
And just, Alison, more from the corporate deal-making perspective, where, in terms of both sectors and regions, where are you seeing the biggest gap between bid and ask, and what stage of the cycle do you think we're at?
Is that for me?
Yes.
Look, we've seen a number of deals this year which are private equity-owned assets, where it's come very, very close, and you'd expect a deal to get done. And as M&A bankers, we can always find solutions to bridge gaps, and they haven't got done. So that, to me, says people have been unable or unwilling to move off their marks. You're starting to see some assets starting to move. You saw a very big deal yesterday in the US with Assured moving. That was a very big deal. I think, we've heard different statistics from different banks, but, somewhere 20-30% of deals, maybe even more, have been done very privately, very quietly, and they failed. And that's really across all sectors, probably bar tech, okay? So what we tend to see is really high quality assets in any sector you can always get a good price for. It's everything else, particularly where there are concerns about growth, where you struggle a little bit more. There is obviously a direct link between interest rates and valuations, and so as the interest rates come down, hopefully valuations will come up, and hopefully things will start to stabilize in terms of growing into those valuations.
The other dynamic is the IPO market, and I think a lot of sponsors are realizing now when they take a company public, they're usually not selling any stock. So if the company is well positioned and ready to go public, I apologize, and the stock trades up over time, it's a way of really exiting and having a second way out to relying on a bilateral negotiation, maybe with one buyer. And so you saw that very successful deal in the aerospace for Carlyle at the end of this summer, beginning of September, and the stock has performed remarkably well. And so while it's not the quick all-cash sale, I think we finally have a functioning IPO market that is another way for these sponsors to have access to liquidity. Yeah. And I think we're going to have a pretty active IPO market in 25.
Actually, one of the themes that we did here today was companies staying private longer, and because they have access to more capital, private capital being one of those. From a financing markets perspective, are you seeing that? Are you seeing that it's becoming easier for companies to stay private because they have more access to cash? It's becoming easier to get deals done because there is more financing available?
I think the financing markets have been fantastic, and with the private credit market evolving to where it is today, it's a fantastic, alternative to even the broadly syndicated markets. But I think it depends, back to the point made about the velocity in a private equity business model. They need to roll over and return capital. And so, yes, they can keep these companies private for longer, and they can do dividend recaps. And there are a couple of very successful large private companies in the tech space that have been private for 20 years, and they just keep doing recaps and selling out interest to LPs. But I would say that's by far the anomaly. I mean, most private equity firms would like to exit, whether it's hopefully in 5 years or less. And certainly, I think the average duration now is north of 6. So I think you can stay private for longer, but if you're a private equity model that needs to return capital to LPs, you're going to transact.
And I was going to say, Ruth, I think there's always been a little bit of a concern in terms of taking those assets onto public markets, because institutional investors who are buying, they always know that, you've got a private equity guy there still owning 30, 40, 50% that's got to come onto the market. So you've got an overhang dynamic that's played as well. So my mindset is it's not the IPO market's been shut. There's been a really big gap in terms of views on valuation between institutional investors and sellers, and that needs to come closer together.
I mean, and just staying with the valuation point, the one thing that we have seen in the UK, for instance, this year is a lot more companies coming off the stock market because of this huge valuation differential between how a UK company is valued and how a US peer is valued. Simona, if we can talk a little bit about, are private equity looking more closely at the UK, especially relative to Europe now because of this valuation differential, even if private equity partners we hear want to leave the UK because of higher taxes?
Now, the UK has been actually the strongest market in Europe in 2024, despite a lot of the noise, despite the political election, and therefore the instability that you always have in a year of election. But it's the first time for a very long time where the M&A has been highest. There is definitely a lot of focus on the UK. The undervaluation cannot be overplayed because a lot of this business, when you start putting a takeover premium, and in the UK is 30% and higher, it doesn't really work any longer. And the uncertainty of getting a deal done means that a lot of the PE were badly burned and have a lot of aborted costs for P2P. So there is definitely, we'll see more that we have seen in the past, but I don't think it will be the major source of deal in the next 12 months. I think the secondary or sponsor-to-sponsor deals will still be the fair share of the market, like they always are in Europe. And then everyone is hoping for this family-owned business to come out and corporate carve-out.
And Europe was traditionally seen as this differential investment case for US acquirers. With all of the uncertainty around some of the political situations, with the concerns around growth in the US, in the European region, are you seeing US acquirers bypass the US and go to Asia Pacific, excluding China? And then where are they investing? Maybe, Alison, we can start with you with your Asia hat on.
No, I mean, I think what we tend to see US acquirers do is acquire really high-quality companies, no matter where they are, obviously somewhere like China. So I suspect a strong dollar means that actually that'll become even more attractive, particularly when you count that valuation gap against them. I wouldn't say I see them moving one region versus the other. To be honest with you, it's all about the quality of the businesses. Both in terms of brands, IP, whatever it may be. I would also expect to see what we've seen for a long time is European and APAC, where they have the ability to invest in the US, investing in the US as well, because the US has become the place that companies want to be, right? Your valuation is the highest, you've got the dollar currency, single biggest market, very attractive margins. So actually you're seeing, I think it's nearly 50% of cross-border activity is into the US. In the last year or so. So I think that trend will continue, and I think the large American corporates and the PE money will come out and pick up attractive but high-quality companies where there's a valuation opportunity for them.
Christina, what are you hearing from US CEOs in terms of where they're looking outside of the US, or is the US now seen as this great investment and growth story, so there's going to be more in-market deals?
I completely concur with Alison, which is it comes down to company strategy and where the best assets are. So, and then of course valuation. And I think the valuations in Europe look quite attractive. And in fact, from a private equity lens, if you have on the ground locations in Europe and you understand Europe, if you're a US private equity firm, those valuations look a lot more attractive. Now we could argue potentially because it's harder to operate, the margins are lower, growth is not there. But I think it comes down to quality of company, and there's just a basic valuation conversation. It does feel that there's a little bit of a America-centric dynamic right now going on just post the election. So many of the phone calls we've had have been a little US-centric from what I can see. But having spent the last couple of days here in Europe, I think European private equity firms are seeing potentially an opportunity as the US private equity firms, their ICs may be a little bit more nervous about what's going on in Germany. Looks like growth is coming down. Do we really understand the geopolitical situation that just unraveled in France? And so I think if you're an American PE firm, you may actually slightly pull away from Europe right now, which I think would bode very well for European private equity firms. So I think it's quite micro to the company, to the sector, to whether you're an American looking at Europe or a European looking at the US, but it comes down to the quality of the company. And the assets that we've been selling that have been super high quality, I'm happy to say have been quite competitive.
Yeah.
It's the second tier assets where you're down to a bilateral negotiation, which as you all know is not a great place to be when you only have one buyer. And that's kind of what we see a lot of, except for these high quality assets where we have 3 or 4 buyers that are very aggressively trying to acquire them at very reasonable and full valuations.
The other thing that we've seen around US private equity firms is a lot of the sound and the fury around protectionism. I mean, we saw that in France with Sanofi's buyout deal. Simona, do you think, well, because those deals ultimately did get done despite the sound and the fury, is rising protectionism a cause of concern for private equity firms? Is it changing their investment decisions at all?
You can look at it actually in both ways, and I think as the Sanofi deal showed, despite all the noise about the French that could never sell to the evil Americans, at the end, guess what? They did, and I wouldn't be surprised if the reason was that the price was higher than what anyone else could pay. So I actually think from a PE perspective, it definitely impacts the way you do deals, the way you structure your SPA, the protection we have. But if you don't, it actually favors PE because it's the strategic that have this issue. No one will ever say, I don't want a US private equity. People will say, I don't want a US strategic in case buying a company in a country because of competitiveness or because of national securities or any other form of foreigner control. So in an environment where it's very hard for strategic in some sector to come to Europe and buying companies, in some countries, the PE who don't have an existing portfolio companies and just buy from a fund can prevail, even with the strategic with synergies, because they can ensure quicker completion and less regulatory scrutiny. So I see the positive side from a PE perspective as well.
Always an optimist?
Of course, always. That's why I cover PE.
Well, they have $1.2 trillion to spend.
So that's cause for optimism. Mario Draghi's report on European competitiveness was making the case for regulators to give more leeway to deal making. That seems timely as Europe faces a very different America in 2025. Alison, do you think the time is ripe for cross-border consolidation in some key sectors like defense, natural resources, banking? Today we had Anna Botín, who was making the case that actually cross-border banking deals are hard and the numbers do not work. What's your take?
That's a loaded question. Good thing she got that one.
No, look. So let's talk banking. I was looking at some numbers this morning. So if you look at the 5 biggest banks in Europe, as in middle of October, versus the 5 biggest banks in the US, the market cap since crisis of those US banks has risen by 892%. For the Europeans, 200%. So fourfold. So what we've seen is that post-financial crisis, the playing field very quickly became uneven, and the US banks have performed incredibly well at the expense of the European banks. So Europe needs bigger, stronger banks, there's no doubt about that. So I would disagree with Anna on that basis. In order for that to happen, we need to facilitate a framework where it makes sense for these banks to be able to do deals and to be able to operate. We don't have that yet here in Europe. So the deals you've seen amongst banks in Europe, there's always been a domestic component to it. So I think you saw Virgin Money Nationwide here in the UK. You've seen Sabadell BBVA, obviously not closed yet. You've seen UniCredit go after BPM in Italy and look at other stuff. So it's still very domestic at the moment. That's the kind of angle to it in Europe. But at some point, that needs to change. And I think at some point, I think people here in Europe are hopeful that, the change of regime in the US and the rhetoric that's coming at the moment about what is coming, let's see, may actually force Europe to unify and actually respond. So it may ultimately be a good thing for Europe.
So maybe.
I hope. We all hope.
Yes, and there are a few banking deals still in the pipeline that may or may not happen next year. But just on M&A, I want to bring something that Jenny Johnson of Franklin Templeton was saying earlier today. She said that M&A bankers will always tell you a deal is a good price and a good fit, but they will never tell you whether it's a good cultural match, and culture is what makes deals work or fail. My question for all of you advisors on the panel today is, how are M&A bankers, how are PE deal-making bankers differentiating themselves in terms of advice, especially at a time when AI is coming for many jobs? Christina, would you like to start with this tough one?
Great.
We already have the answer. We gave the answer earlier. We debated this.
We were talking before the panel that we concur that often deals are looked at just, is it accretive or dilutive, and what's the math, and does the premium represent fair value, but the cultural fit, the sort of EQ nature of these deals, I think if we had more women that were more focused on cultural fit
Fair point.
and integration, it would help. But I was chuckling thinking through my own M&A teams. It's rarely discussed. Culture, fit's discussed, strategic fit. If you're buying a professional services company, you hear a lot of discussion about culture and fit. But if a healthcare company is buying a healthcare company or an industrial company is buying an industrial company, you really don't hear much about cultural fit from the M&A bankers. We talked a little bit about private equity firms have different cultures and different approaches to management teams. Mm-hmm. And we do spend a lot of time thinking about that when we're forming consortium, because I think there's certain private equity firms that pair very beautifully. And there's certain private equity firms that have again, mostly run by men, have a little bit of this going on, so it's not that constructive in a deal-making mode. But I don't know, what would you say?
No, I agree, and we debated this earlier, but also for someone who works at UBS, we just acquired Credit Suisse, so we went through a cultural integration which was quite dramatic. I can see how culture was clearly not one factor of consideration in that deal, but how it became very important day after to figure out when we were assembling team and coming together. Culture became an important lens on which we really assess team formation and how to be more effective working together. So I'm now, if I wasn't before, now I'm very aware of the importance of culture in deal making.
We've got very little time left. If we could just do a rapid fire with your top predictions for 2025. Alison, if you can take global M&A and start.
Look, I think it will be a better year. I don't think it's going to be quite the crazy euphoria that we're hearing out of the US right now. I think it will be a better year. I think volumes will probably be up from where they are this year, 20-25%. A decent year, and I think there'll be a fair amount of activity both in the US and in Europe, and it will be the same trends that we've seen.
Okay. Simona?
I think from my PE perspective, and we haven't talked about that, but I think a lot of what we were discussing will drive more consolidation among the PE firms themselves. So there will be M&A at the GP level.
Okay, so M&A and PE.
And then on the financing side, I think the markets will continue to be very strong. It's hard to imagine the volumes will continue to be up 80, 100% like we saw in loans and in high yield. But I do believe you're going to have growing private credit. You're going to have rebound and broadly syndicated, and getting the deals financed, not going to be a problem. Not going to be a problem.
So no risk predictions.
Look, I think it's my mindset is we bankers will go through a make hay while the sun shines moment. Things look okay for now. We'll be able to get deals done. How long that lasts and what stops it is a very different matter. And I don't want to predict what that might be. I could think of 100 things.
We keep dancing while the music is playing.
Yeah.
Ladies, thank you so much. It has been an absolute pleasure.